What's going on, guys? Welcome back to another video. We are off to a very hot start this week in the market. The market's rebounding from the craziness that we saw last week. We have a lot of events happening this week as well, and the market is doing something that we have just recently seen. And honestly, I wouldn't even call it history, but what we have just seen in the market could be replaying itself over again, and I want all of you to be prepared for that. So team, we have a lot of information to cover here. Let's get right into it. Again, if you guys wouldn't mind, make sure you guys drop a like down below. These daily YouTube videos are back 4 times a week, and make sure you guys are subscribed and have notifications on so you guys do not miss anything. Now, speaking of a hot start to the week, you guys see the screenshot of the gains that we had from an absolutely insane trade on MNST this morning here. Really solid swing trade to start off the week. This was directly from the weekly watch list that I send out to you guys every single week in the Discord. So again, if you guys haven't hopped in there yet, make sure you guys do. Everybody gets 2 weeks free. Link down below. The private live streams are going to be starting next week. Currently, we're live every single day on this YouTube channel, but those live streams are going to be private for you guys coming up in the near future. Now, the first thing that I want to talk about with you guys is this situation with the Bank of Japan's Ueda and kind of their overall viewpoint on what's happening in Japan and what they could potentially do with rates. So they effectively said that if these economic conditions that they are witnessing right now stay relatively the same, they will be looking to raise interest rates again. Now, this is effectively like a jawboning statement, trying to basically project some fear into some markets just to kind of say, hey, if anything goes wrong, we are not going to back down and we will not hesitate to raise their interest rates even more. And as you guys know, we talked about this a lot. The main reason for this significant sell-off that we saw in the market was due to the Bank of Japan raising interest rates and the unwind of that carry trade. But what did we just see? The Japan's second quarter revised GDP was revised lower. So what does that mean? Well, they're not growing as much as they had previously thought, and that could kind of quell concerns over whether or not Japan is going to be raising interest rates again this year. After initially, after that first interest rate hike, they basically came out and said, oh yeah, we can't do that again because of how catastrophic it was for the broad market. So keeping that in mind, looking at what's happening with USDJPY right now, I mean, obviously it is starting to move back up a little bit. This is the danger level down here, though. If we do start to sell down below this, what is it, like 140, 141.60? Yeah, 141.68, right around that area there on USDJPY. We easily could see the further unwind of the carry trade. And again, for those of you guys in the Discord who read that most recent macroeconomic research report that I gave you guys, we talked about this a little bit more. But we could easily see a really strong move in bonds as a further move down in USDJPY could start to trigger the bond positions that these large institutions were taking due to the fact that they were getting a loan from Japan and also putting money into the bond market. And that is one of the reasons here where a lot of people, including myself, I mean, we look at this chart all the time with the 10-year yields, treasury bonds across the board, and specifically TLT here. But looking at TLT on the weekly time frame, what do we see? Well, we see this really strong zone back in here that was used as support, and it is now turned and is being used as resistance. So if this is going to be effectively tracking yields inverse effectively, we can actually pull up the 10-year yields right now to kind of show you guys this here. Again, if yields were to fall lower here and drop off this cliff that we are seeing, which is possible, we would expect to see TLT moving to the upside. Now, to me right now, this trade is a little bit too obvious, where a lot of people are coming into the market and thinking, oh, the Fed is about to cut rates, and that means that obviously rates are going to come down even further. But what people are failing to realize is that all of these interest rate cuts that the Fed is projected to make are already priced into the bond market. So what you have to think about right now is, well, how much further or how many more rate cuts are they actually going to price in? We are kind of already pricing in too many right now. So if they continue to do that, yeah, you could see a little bit of a shoot up in TLT here. But again, I don't really think that that is going to be very long-lived, and we could easily see a bounce in yields. Bonds sell off a little bit as money starts to flow potentially back into the equity market, which is what we're going to be talking about when we think about the title of this video when we're thinking short squeeze happening again. Now, the other thing that I want to briefly cover with you guys Are these inflation expectations moving back a little bit to the upside, specifically on the 3-year area? Now, we're not going to do a whole deep dive into inflation expectations, but I want you guys to understand that just kind of the overarching elements of what inflation expectations going up actually means. If consumers and everyday people in an economy are thinking, oh, inflation's going to be higher in the near future, or over the next, let's say, 3 years, like this is how we are seeing these expectations moving to the upside. Well, then what are they going to do? Well, they're going to demand higher wages from their employers. And think about it from the employer side. If they start to give those wages, they have really two options. They can either not give those wages and perform more layoffs, which could hurt the economy, or they could give higher wages, but then they're going to have to increase prices, which is then going to lead to further inflation. So it's this vicious cycle that if consumers are expecting inflation to be higher, a lot of the times it actually can end up moving to the upside in that way. Now, let's talk about what is happening with the market right now, and why I titled this video Short Squeeze Happening Again. When we saw this significant move down in the markets towards the end of July here, mid-July, going into August, and then we saw this snap move to the upside right back up, we talked a lot about the fact that a lot of people didn't really realize why the market was coming down here. People were pointing to the non-farm payroll report, but what was really going on was the unwind of the yen carry trade. And then once that situation started to calm down a little bit, and we saw those notices from the Bank of Japan that they were saying they weren't going to hike rates again. That was kind of the initial part of the timeline there. We saw the big sell-off in USDJPY after the hike. The Bank of Japan members came out and said, yeah, we're really not looking to do that again. And now we have started to see them say, well, don't everybody go crazy. If things start to get worse, we will hike rates. But with that new economic data, it doesn't necessarily look like they're going to be doing that in the near future. But that's what was happening here. As soon as we saw that, the market started shooting right back to the upside. So what are we seeing now? What has recently come out that has kind of shown us, oh, the market could be in a really bad position? Well, the one thing that we saw was non-farm payrolls on Friday, where the unemployment rate came out at about 4.2%. And what we were talking about, I mentioned this on Twitter, and I was writing about this in the macro research reports that you guys are getting in the Discord there. But what you have to think about is we all know that the payroll numbers are getting messed with, manipulated. They're effectively cooking the books. So if an unemployment number comes out with the expectation and the prior number was at 4.3% and it only came down to 4.2, what the market was probably looking at here on Friday was saying, that's the best you could do? How bad are the numbers actually? And what is it actually going to look like once we get those new revision numbers later down the road? Now, the same thing was kind of happening back when we were moving to the upside, specifically in June, where we were seeing a lot of this good payroll data, and then it came out and said, oh, it wasn't actually that good. So does the market really deserve to be up at these levels? Not necessarily, which is one of the reasons why we were moving to the downside there. But mainly because of the unwind of that yen carry trade. So what are we seeing right now? Well, there's a lot of bearish people in the market. When you look at the state of the economy, it's not good. You have a struggling consumer. You have, I'm going to call this the capital K-shaped economy now. I think we should coin that term, where if the Fed starts cutting rates now and does what the market wants it to do, and you get those big 50 basis point cuts, even if inflation doesn't reaccelerate back to the upside, if you see long persistent periods of 3%, you're going to get into a period where assets are probably going to appreciate over the next, let's say, 10, 15 years. And the people who are able to hold assets are going to do very well. The people that aren't, the people at the lower end of the totem pole, are really, really going to struggle. So that's effectively what we're looking at across the board. But when we look at the market going into a cutting cycle historically, it tends to not do very well because think about it. If the Fed has to come out and cut rates, what does that tell you about the economy? Well, it's obviously not doing very well. So the market tends to sell off. Now, what you could be seeing here is institutions and large money managers front-running this move down. Now, while I do think that there is some room for more potential downside here, this could just be a little bit of a relief bounce after 1, 2, 3, 4 straight down days here. If the market starts moving up with any bit of steam, we are going to see the exact same things that we saw happen back down at these ranges, where a lot of the people that were shorting down at these levels here are going to get squeezed out of their positions, and the market's going to trend higher. I mean, typically, you're going to see these really, really high volume candles down here, and then the shorts covering on a little bit of lower volume, pushing the market back to the upside. That's kind of what you're seeing today. I mean, the volume isn't that low. I mean, right now it's about 3:48 p.m. Volume on ES right now is about 1.352 million. Let's actually take a look at SPX and see how that looks here. 1.788 billion. And then let's take a look at SPY just to kind of give a look here. SPY, a little bit lower volume than the other ways to kind of monitor the S&P 500 here. 31 million versus Friday's 68 million in total shares traded. So it is possible that we do end up seeing this snapback moving to the upside in the market, where a lot of people are going to be looking at it kind of with their hands up in the air and saying, what the heck is happening here? Because when we see these large aggressive moves down, people are going to expect to see it continue. Now, it could, but that's not always the case. I would say that a good spot that we could come down to probably be about 531, right around there, before we get that bounce. But it is all going to depend on what we are going to see this week with CPI and PPI. So I made this joke almost the other day on or Friday on the live stream, where if you see really good data, the market sells off. If you see really bad data, the market also sells off. Because if you see good data, like growth reaccelerating, let's just say, or let's say CPI is really declining to the downside, well, you're going to have the rate cut expectations really skyrocket, and the market is probably not going to like that at this point. On the other side, too, if you see hot CPI, the market's really not going to like that. Those rate cut expectations are going to get pared back, and the market's probably going to sell off anyway. So what the market's really looking for here is Goldilocks. They want all of this data to come in at expectations. If it does, that is the way for the markets to come and continue moving back to the upside. But remember, we are fighting the seasonal effects of September. Remember, I'm not the biggest fan of seasonality, but it is something to keep in mind. October, typically a good month in the market there, but what I want you guys all to realize, especially from a trading perspective, I mean, MNST is a really great example of this today, that there is always going to be, let's say, a bull market somewhere or stocks that are ready to explode. You just have to know where to look. Yep, you can day trade every single day, and we have all of that education as well in there, making sure that you guys have everything that you need in order to have success over the long term. But in periods like this, you have to be a little bit more picky with what you're looking for. Like, I'm not just going to go out and start trying to sling calls on Mag 7, like Tesla, Apple, Nvidia, Amazon. It's not going to happen. But looking for tickers like this that have been beaten down, that are looking like they are setting up really, really, really strongly, and as you guys can see here, paid us very handsomely. So, again, just to kind of wrap this up here, looking at ES, it is very possible. However, I want to be careful here, just because I don't want anybody to just start longing everything. It is possible that this is either a small relief bounce or the beginning of the market starting to squeeze higher on a little bit of lower volume. What you really have to look out for this week, though, is CPI coming in, and we have to continue monitoring the situation with USDJPY and the Japanese yen, because again, this carry trade is not fully unwound. It is going to be something that we continue talking about over the next couple of months here, because if it starts to really move to the downside here, USDJPY, and you see that further repatriation, the money's going to flow out of the US equity market and the bond market, and we will continue selling. But if we can flip back to the upside here, that is going to give a little bit of breathing room for the broad market. So guys, that's going to wrap it up for this one here. If you guys did enjoy the information and analysis I provided for you guys, make sure you guys go down and hit that like button. Costs you nothing to do it. And if you guys are interested, Discord link is down, linked below as well. Everybody gets 2 weeks free. I'll see you guys in the next one. Peace.